So here we have Jocatt. We're given a statement of financial position, a statement of profit or loss, and we're given the statement of changes in equity. Now, my advice to you is that if you're given a statement of changes in equity, ignore the equity section in the statement of financial position, because all of the data, all of the numbers you actually require are built into your statement of changes in equity. In your extra 15 minutes, do your cross-referencing. Then let's start to work our way down the question line by line. This question will, in all probability, involve you preparing an awful lot of T accounts. So be prepared to debit and credit like you've never debited and credited before. So having set out my pro formas, I come to my working section. The first thing that I see is PPE. And all I'm going to be doing initially is opening up all of these T accounts and slotting in some balances, because I've done some cross-referencing, and practically every item in certainly our non-current assets is referenced to some of the bits and pieces in the rest of the question. So we've then got investment properties, at 6 and 8. Goodwill. $68 and $48. Intangibles. $72 and $85. We've got an associate at the end of the year. Nothing brought forward, a figure of 94. And then we've got some investments. Opening balance 90. Closing balance 94. So that's what I'm going to do for all of my non-current assets. We then come to our current assets. So what I'm going to do here, start off with profit before tax, and we'd normally have a section movements in working capital. In terms of inventories, what's happened to inventories is that they've gone down. But I've referenced that we've acquired a subsidiary in the year, so this might need tweaking. But if not, we're going to use our golden rules of cash. In theory, this is going to be inventories down. We'd expect cash to go up. The same broad principle applies to receivables. Receivables have gone down by 51. And I'll come back to that later. Next, we've got cash and cash equivalents. So our opening cash and cash equivalents is 143. Our closing figure is 232. So what's happened to cash? Cash has increased by 89. Now, in theory, if we add up our cash flow statement, it's going to add up to 89. I would not advise adding it up in the exam. Just pick up as many marks as you can. So that deals with the top half of our statement of financial position. Next we come to equity. All of the equity items I'm going to push back. I'm going to leave those until I get to our statement of changes in equity. Now we come to non-current liabilities. In terms of borrowings, I'm not sure we've got any further adjustments to this, but they've gone down. Liability down equals cash down. As far as tax is concerned, tax is an item that appears in both the statement of profit or loss and the statement of financial position. And my advice for those is always to open up a T account. So we've got an opening balance of 41 for deferred tax, a closing balance for deferred tax of 35. Pensions are messy. The reference to one of the notes in the question. What do we have? We have a net liability as far as the pension is concerned of 22 at the start of the year and 25 at the end of the year. Back up to working capital items. Payables have gone up by quite a large amount. Liability up equals cash up. The amount involved is 89, and then current tax, it's a liability. The secret with tax is to combine deferred tax and current tax. So I've got a figure of 30 and 33. So we've now dealt with the whole of our statement of financial position. By having a technique using T accounts, you can get a lot of data down onto your answer sheet quite quickly. We next turn our attention to our statement of profit or loss. And the first thing I always look for is profit before tax, because that's going to be the start of my statement of cash flows. So in terms of profit before tax, we're kicking off with 59, and I then look above that and I'm going to adjust for two things. First of all, any expenses or income which is not operating in nature, and secondly, anything which is not cash in nature. So let's go immediately above profit before tax, and the first thing that we see is share of profit of associate. And the secret is to do the opposite in your statement of cash flows to what you're doing in the income statement. So in the income statement, we're adding profit. In our statement of cash flows, we therefore take that away. But I've also got an associate T account. So let's think about what we've done here. We've put the associate's profits into our statement of profit and loss. So that's credit P&L, debit T account. So associate, credit P&L, debit T account with 6. We've got a gain on property. I'm not sure what type of property this is, but I suspect it's an investment property if it's in the income statement. So property gain, as it's a gain in the income statement, it's a deduction. As that's in the income statement and it's a gain, it must be an investment property. So what are we doing? Credit income statement, debit investment property account. Although I've referenced that one of the notes, so perhaps I'll come back to that a little bit later. I'm not certain exactly what's going on there. Finance costs. Finance costs are deducted in the income statement. So therefore I'm going to add them back to profit. And you have a choice when it comes to finance costs. They can either be in the operating or the financing section. Because my operating section is looking quite busy, I'm going to drop down to the financing section simply because I've got more space here. This is being done for practical reasons. Now there could be an accrual to deal with, but I'm not sure. So those are the adjustments I've made. Can't see anything else. We've got some other income, not quite sure what that is. We'll come back to that later. Next, we come to our income tax expense. Debit P&L, therefore credit the tax T account with 11. So that's dealt with statement of profit or loss. We then come to OCI. We've got investment gains. So we've got an investment T account. Gain in OCI is 2. We've got losses on a property revaluation. So I'm assuming that's PPE. Go to PPE, revaluation loss, OCI is 7. And we've got a debit. We've lost money on presumably our actuarial issues in relation to the pension. So I'm going to go down to my pension account. I've debited OCI, therefore I'm going to credit the pension account. Loss on remeasurement or actuarial loss is 6. We're then given information splitting profits between the parent and the NCI. Now, if you were not given a statement of changes in equity, I would use that data in my T accounts to calculate dividends paid to the OCI, so to the NCI and to the parent. But because we are given a statement of changes in equity, that information is in fact not required as far as this question is concerned. So now we turn our attention to the statement of changes in equity. I'm going to go through the items one by one. First of all, we've got share capital. We've issued some shares. I don't know whether we've issued them for cash yet. So go to financing, share issue, equity up equals cash up. I'm going to show that as a positive. We've got retained earnings. Notice in retained earnings we've got a dividend paid. So dividend paid to the parent shareholders is 5. Next we've got our investments. Well, that's fine. We've just got a revaluation in those. We've dealt with that revaluation already in OCI. We've got a revaluation surplus, but we've dealt with that in OCI, so that's already dealt with. We now come to the non-controlling interest. And the non-controlling interest looks quite complicated, but the important thing I'm going to pick out is the dividend paid to the NCI of 13. I'm not quite sure what's happening with the acquisition and the rights issued, but I've referenced those to notes 1 and 2 as part of my planning for my answer. So therefore, I'll deal with those when I come to notes 1 and 2. So we've now dealt with the first 2 pages of the question. So we're 2/3 of the way through. Possibly, possibly not. Let's now take a look at the additional information, and the first thing that we see in respect of Jocatt is it's acquired a subsidiary in the year. And it says that changes in fair value are taken to profit and loss. We didn't have any changes to profit and loss come forwards, but on the 1st of January, Jocatt became a subsidiary. And we've got our consideration. And our consideration there is 34. So what I'm going to do here is I'm going to do a goodwill calculation. So it's a new working, and the exciting thing for us, it's not a T account. You could do it as a T account if you wished, but goodwill in respect of Tigray or Tigret. Tigrets, we've had a few, but then again, too few to mention whilst doing cash flow statements. So what I've got here, cost of investment, we've got 4 plus 30, which is 34. It then says, at the 1st of January X2, the fair value of our original holding in the business was 5 million. So what we have to do is to revalue our original investment upwards. So increase in original investment. We bought those shares for 4. We've revalued them to 5, so we've revalued them up by 1. Now, gains, we're told in this note, are taken to profit and loss. Is that gain a cash flow? No, it isn't. It's a revaluation. So what I'm going to have to do here is to go up to here and say gain on the Tigray shares. And that gain is 1 in the income statement, so therefore I'm going to take away 1. And I'm also going to have to go to my investment note, and I'm going to say here, in respect of Tigray, we've got a revaluation of 1. Okay. And what also are we going to be doing at this stage? Well, Tigray becomes a subsidiary. If it's a subsidiary, it's no longer an investment. So I'm going to say Tigray becomes a subsidiary, and I'm going to take Tigray out at the value when it becomes a subsidiary, which is 5. We're told the fair value of the NCI was 20. That ties in to the figure of 20 in our statement of changes in equity. That's a non-cash item. We don't have to adjust for it. The purchase consideration was cash of 15 and shares of 15. So what I'm going to do is I'm going to use that information, and I'm going to go up to investing activities, paid to acquire subsidiary, and that's 15 million coming out. And when we go into share issues, I've had a share issue of 15, but I didn't receive cash for the shares. Instead, we used that as consideration in respect of our investment in the subsidiary. So actually, our share issue proceeds, there weren't any during the year. Now, I still think it's important to show that as a 0 in your answer, because if you write nothing, I, as the marker, might think, well, they don't understand what they're doing, so I'll give you nothing. There is more marks for a 0 than for a piece of blank space, because a 0 shows that you thought through the process. We're then given information in respect of Tigray, and remember you have to strip out the assets and liabilities of a subsidiary. when looking at movements in the year. So the first thing we see is PPE, subsidiary at acquisition was 15. We've then got intangibles, so we go to our intangibles note, subsidiary at acquisition is 18. We've then got 5 in receivables, so go up to receivables, and I'm going to reduce that by a further 5 in respect of the subsidiary. And we've then got cash of 7, so we go to our investing activities, cash of subsidiary at acquisition is 7. So the net cost of buying the subsidiary, it's cost us 8 million. So if we add all of those up, we need to do this for our goodwill calculation. Net assets of subsidiary at acquisition. It's 15 plus 18 plus 5 plus 7 is 45. We need to add on our NCI at acquisition, and we're told in the question that the NCI at acquisition is 20. So the numbers are always there for a reason. Practically every number is going to appear somewhere in our question. Now this is where the question gets really horrible. It then says the tax base of the assets was 40 million. Now there's a really good case for saying, whoa, this is far too silly for me, I'm going to ignore it. But if you want to nerd out, we've got the deferred tax on the acquisition of Tigray. The carrying amount of the assets we've just established up here is 45. The tax base of those assets is 40. Because the carrying amount is greater than the tax base, this gives us a taxable temporary difference of 5. We're told that the tax rate is 30%. So that means we've got a deferred tax liability in respect of Tigray of 1.5. What am I going to do with that? Well, it's going to go into my goodwill calculation. So actually, I'm going to add, it's going to reduce the net assets by 1.5, isn't it? So net assets are actually now going to be 43.5. And it's arisen in respect of the acquisition of the subsidiary, so therefore it's going to increase our overall tax liabilities. So I'm now going to go up to my taxed account, subsidiary and acquisition. That's come from working number 10. 1.5. Again, it's one of those really complicated things which, if one student in 1,000 deals with correctly, that's fantastic, but it's not going to be a discriminator. It's not going to be the difference between passing and failing. It's going to be the difference between getting a 75 and a 76 in the exam, not between a 49 and a 50. So we've now got sufficient information to calculate goodwill. So I've got 35 plus 20 is 55 minus 43.5. So I calculate goodwill arising in respect of the subsidiary as being 11.5. I'm going to take that figure of 11.5 that's Tigray, and that's come from, is it working 9, working 10, lose track, yeah, working number 9. But the important thing as you work through the question is to have a technique to stay calm bit by bit. If you can't do it, move on to the next item. So that deals with note 1. That's a big note. On the 30th of November, Tigray, which is our subsidiary company, made a rights issue on a 1-for-4 basis. The rights issue was fully subscribed and raised 5 million in cash. Well, remember, we own 60% of Tigray. The NCI own 40%. That explains that figure of 2 million in the NCI calculation. So what I'm going to do here is I'm going to go to financing and rights issue to NCI. That has brought in 2 million. So that's note 2 dealt with. Note 3. We purchased a research project from a third party, including certain patents, for 8 million. And recognised it as an intangible. So let's go to intangibles. So we've got some purchased intangibles worth 8 million. If I've purchased them, that's cash going out of our business. We invest in intangibles, in long-term assets, so up to investing activities. Intangibles purchased a further 8 million. During the year, we incurred further costs, which we included 2 million on completing the research. Well, that will have been written off to the income statement. 4 million in developing the product for sale. Well, that can be capitalised. So we've got capitalised costs of 4 million and 1 million for marketing. Well, marketing is written off, so I'm going to add in an extra 4 million for capitalised development costs. Up to my income statement. Capitalised development costs. And you could combine this with the intangible above if you so wished. There were no other additions to intangibles other than the acquisition of Tigray. Okay, that's fine. Jocatt, note 4, operates a defined benefit scheme. What we need to do is to work out what's happening here. Our profit and loss charge for pensions well, we're going to have our service cost of 10 million. We've got an enhancement of 2 million. If you have an enhancement during the year, that's charged to profit or loss. And we've got net interest on assets of 8. So the overall cost is 4 million. That's our expense in the income statement. That is not cash. So if it's not cash, you add it back. But it is debit profit or loss, 4 million, credit pension, 4 million. So I'm going to pop down to my pension T account, profit or loss, expense, 4 million, like so. Note 5, we own an investment property during the year. We've got a heating system which was replaced by a new one. So if it had a carrying value of 0.5 million at the disposal date and we've got rid of it, that's a loss on disposal. So that would be charged to profit or loss. So we go up here. Loss on disposal of investment property asset. If it's a loss in the income statement, I'm going to show it as a gain here. So it's going to be debit profit or loss, credit our investment property, income statement, disposal loss, 0.5. We've replaced it with a new one which cost 1 million. So this is our purchase. That purchase is for cash, so therefore it goes into our income statement. Purchase of investment property assets, 1 million negative. We're using the fair value model because, of course, you do have a choice with investment properties. I'd never get that wrong, would I? So that's note 5 dealt with. Next, Jocatt exchanged surplus land with a carrying value of 10 million for cash of 15 million and plant valued at 4. So I'm going to go to my PPE note, and we've got a land with a disposal of 10. What have we done? We've got plant which we've swapped for land coming in at 4 million. We've also received cash of 15. If it's cash, it's go to investing, disposal of PPE 15. Let's just work out what's happening there on our overall gain or loss. You might want to summarize this in a T account. PPE disposal. We've got the land coming out at 10. We've got the plant swap coming in at 4. And we've got cash coming in of 15. That means, in respect of that particular item, we've got a gain of 9. Now that gain is included as part of our property gain of 10.5. Now this is where it gets really sneaky. If I've got total gains of 10.5 and 9 of the gains relate to PPE, the other gain must relate to our investment property. And that's really nasty. So gain in year, the total gains are 10.5, of which 9 relate to PPE. So the gains on investment properties must be 1.5. That's a pretty horrible thing to expect a student to do in the stresses and strains of the exam. To such an extent that not a single student on the planet got that right. And I wouldn't expect them to. Depreciation for the year is 27, so we go to PPE. Depreciation is 27. I'm going to add that depreciation back. To profit because it's a non-cash expense. We've got a goodwill impairment. We'll come back to that, related to those subsidiaries which are 100% owned. There's no NCI considerations. Deferred tax of 1 million in the year arose in respect on the gains on investment. So what I'm going to do here, I'm going to go to my investment account, gain deferred tax, add that to investments, debit investments, credit tax, DT on investments, 1 million. The associate did not pay any dividends during the year, and therefore we've dealt with everything in the question. So that's taken me 36 minutes, and I've still got all of the T accounts to tidy up. What I'm now going to do is to go through our housekeeping exercise. But if you've done this, you will have picked up an awful lot of marks. It is usually quite useful to try to crank out some of the T accounts to work out some of the missing figures, though. There are plenty of marks available for that. So let's just see what's remaining. So we've got PPE. Credits of 371. Credits must equal debits. Balancing figure is 98. That's additions for cash. So we go to our cash flow statement, PPE additions 98. That's from working number 1. Investment properties 67, 8.5 equals 8.5, no further adjustments. Goodwill debits 79.5, credits 79.5, balancing figure 31.5. That's our impairment, which is referenced to in one of the notes. And that impairment is 31.5. That's a non-cash item, so we add it back in our statement of cash flows. Goodwill impairment 31.5. Intangibles 72 plus 18 plus 8 plus 4, 102 versus 102, balancing figure of 17. That must be amortization of intangibles. If we've amortized our intangibles, that's a non-cash expense. It needs to be added back in our statement of cash flows. Rapidly running out of space. It should be up here. I'm actually going to stick it a little bit further down. Amortization 17. Associates. What must we have done during the year? Well, we must have gone out, we didn't have an associate, we must have gone out and bought some shares. They've contributed some profits. So how much did those shares cost us? 48. That's going to be our cost of investment. Because it's an investment in an associate, that's cash going out of the business. So I'm going to try to find investing activities, acquisition of associate, 48. If we look at investments, credits come to 99, therefore debits must also come to 99, balancing figure of 5, cash additions. We've gone out and we've bought some shares during the year. So I'm going to show that as a cash expense in my investing section of the cash flow statement. Still very much running out of space here. Investments purchased, 5. Tax, 41 plus 30 plus 11 plus 2.5. Credits are 84.5. Credits must equal debits. I've got a balancing figure of 16.5. That must represent cash tax paid of 16.5. You pay tax in the operating sections of your cash flow statement if you've got enough room. Tax paid 16.5. Pension, 32 must equal 32. It doesn't balance by 7. What have we not dealt with in terms of pensions? We've not put in the cash contributions. So this must be the balancing figure. Cash contributions are 7, like so. Pensions are operating activities. Let's go up to our cash flow statement. Pension paid, 7 from our workings. We can now put in our movements in working capital. No adjustments to inventories. They're minus 23. Receivables are minus 56. Payables are plus 89. Quick check. Any other workings need reviewing? We've dealt with the PPE disposal. Everything appears to have been dealt with. Don't bother to add up the subtotals for operating and investing and financing. It's not going to balance on the day. But if you have a methodical approach, then you're in with a good chance in the exam. Just a couple of quick adjustments. Receivables went down, so that should be plus 56. Payables, inventories went down, so that's plus 23 in terms of cash. Add up the totals, and I've got plus 268 for operating. Quickly pop down to investing, minus 153. Financing, minus 26. Add those three together, and that gives us plus 89, and it all balances.